You are standing in Tianjin, on the edge of a city that exploded upward in 30 years. In front of you rises a skeleton of concrete and steel, bare, unfinished, frozen mid-air, at 597 meters tall. This is Golden Finance 117. It was supposed to be one of the world's tallest buildings. $3 billion went into this tower. $3 billion. And it will never be finished. The construction cranes have not moved in years. The scaffolding is still there, rusting. You walk to the foundation line and place your hand on the concrete. It is cold. Now, here is what most people miss when they see a tower like this. This building did not fail because of a single mistake or a single bad decision. It failed because of a system, a way of building, a way of financing that was broken from the start. I have spent 20 years studying how structures fail in fast-growth cities. My father was an engineer in Shanghai. He watched the first boom. He saw the cracks appear. What I am going to show you in the next few minutes is how a $3 billion bet collapses. I will walk you through the exact moment this tower began to sink, literally and financially. And stay with me to the end, because there is one detail about how these towers were funded that nobody in the industry wants to talk about openly. It changes everything about how you see China's skyline. Golden Finance 117 is not alone. There are hundreds like it. But this one tower, and the people who bet their life savings on it, shows you the whole rotten system at once. So let me take you back to the moment the engineers first noticed the sinking. That is where the story really begins. Now I will show you how that tower was paid for and why it was never meant to be finished. In China, you do not build a skyscraper with money you have. You build it with money you do not have yet. The system is called pre-sale. A developer buys land. Before one brick is laid, they sell apartments to homebuyers. Full price. All of it. Paid up front by people who will not move in for 5, sometimes 10 years. I have watched this cycle since my father first explained it to me in Shanghai in 1998. Here is the trap, and it is elegant. The developer takes that money and does not finish the building. They use it to buy more land. Then they sell more apartments off that land. Then they buy more land again. It is a chain. Each new project funds the previous one. It works perfectly until the chain breaks. By 2020, a developer like Evergrande had over 1,300 projects running simultaneously across 280 cities. Evergrande alone had borrowed more than $300 billion, most of it offshore, in foreign currency they did not earn. The bigger the company grew, the more reckless it became. They bought into electric vehicles, water companies, pig farms, even a soccer club. Capital spread so thin it had no weight anymore. Every project relied on the next one to exist. Meanwhile, regulators finally moved. In August 2020, 3 new rules arrived: debt caps, equity requirements, cash reserves. The 3 red lines, they called them. Suddenly, the chain could not grow anymore. Developers could not buy new land at the prices they needed, could not issue new bonds, could not collect new pre-sales as freely. The cash stopped flowing, not because the buildings were bad, because the system that funded them had cracked. And here is where it matters most. By then, the backlog of unfinished projects had swallowed the savings of 50 million homebuyers. You are about to see what happens when the machinery that moves money through an entire country suddenly ceases. Now here is what happens when that funding chain snaps, and I mean snap. Overnight, August 2020, 50 million people hold contracts. Zero cash flows into construction. The sites go silent. I have walked dead construction sites in Shanghai, Tianjin, Shenzhen. The silence is physical. The first domino is concrete. Anhui Conch Cement, one of China's largest suppliers, suddenly has no buyer. Evergrande alone owed tens of billions of yuan to hundreds of thousands of suppliers across the country. Small concrete firms, operating on margins thinner than cardboard, face insolvency in weeks, not months. Next, the steel suppliers. Construction historically consumes 30 to 40% of all Chinese steel output. When the sites stop, steel mills watch their order books evaporate. Revenue collapses. Glassmakers, elevator companies, interior finishers, all tied to new apartments, all get dragged down together. This is the mechanism I want you to understand. One broken developer pulls the entire material chain backward. Now the workers. Migrant construction laborers, hundreds of thousands on Evergrande sites alone, stop getting paid. Some owed wages, stretching back over a year. No notice, no severance, just silence. By 2022, groups of workers staged protests at Evergrande offices in Shenzhen, Guangzhou, demanding what they were owed. These are not abstract numbers. These are men and women with families, rent, debts of their own. The financial hit spreads next to the banks themselves. Here is where it gets interesting. Homebuyers, ordinary middle-class families, stop making mortgage payments on apartments they cannot move into. By July 2022, a mortgage boycott emerges. It spreads to over 300 projects across 90 cities. Trillions of yuan in mortgage exposure sits on the balance sheets of Agricultural Bank, ICBC, Construction Bank. The smaller regional banks, with less diversified portfolios, face insolvency first. Trust companies that had channeled retail investor money into developer financing begin to default on wealth products. Millions of ordinary people who thought they had invested safely now have nothing. Cement sales drop, steel demand collapses, glassmakers fold, workers starve, banks hemorrhage, suppliers vanish. One broken tower became a chain reaction that touched every link in the system. But here is the part that reshapes the entire nation's credibility. What happens when the government itself realizes it cannot contain this alone, and when the world watches it try? With 50 million homebuyers refusing to pay mortgages across 300 projects, the Chinese government faced a choice that would reshape its standing globally. In December 2021, Evergrande officially defaulted on its offshore dollar bonds, the moment international investors realized their money was gone. BlackRock, HSBC, and every major asset manager holding Evergrande debt took a loss they could not hide from their own investors. Moody's downgraded China's entire sovereign outlook to negative in December 2023, citing the property sector as a structural wound. Now here is the part I promised you at the start, and it is why this tower matters beyond Tianjin. Xu Jiayan, Evergrande's founder, had been moving assets and money out before the collapse. Transfers that investigators are still untangling today. The offshore structures, the Cayman Islands holdings, the complex layers between mainland assets and Hong Kong-listed shares, they all meant enforcement was nearly impossible. A Hong Kong court ordered liquidation in January 2024, but mainland China had no obligation to recognize it under the same legal terms. The hidden truth: these towers were never built to shelter people. They were built to move money through a system designed to fail. Foreign direct investment into China fell sharply as international investors questioned the transparency of Chinese corporate balance sheets. Credit rating agencies lost faith in Chinese disclosures, and the entire Chinese high-yield dollar bond market froze for new issuance. Let me show you what happened on the ground where the decisions rippled down. You are standing in a second-tier city whose local government relied on land sales for 40% of its annual revenue. Land sale revenues collapsed 23% in 2022 alone, a fiscal shock with no recovery in sight. Schools went unpaid. Hospitals delayed supplies. Local officials faced a gap they could not fill. Across the property sector, new investment fell 10% in 2022 and kept falling through 2023, dragging China's entire growth forecast lower. New home prices fell for consecutive months in the majority of 70 major cities tracked by the National Bureau of Statistics. The government cut mortgage rates, loosened buying restrictions, created whitelist mechanisms to push banks toward completion guarantees. None of it moved the needle enough because the real problem was visible. People stopped believing the asset would climb again. This is the damage that matters most, not the bond losses or the liquidation order, but the generational shift in how an entire nation saves. The property market, which had been the primary wealth vehicle for Chinese middle-class households for 3 decades, lost its claim on trust. So, here is what I want you to notice in your own life. When a system is built on perpetual growth and renewal, its collapse teaches everyone watching. Have you seen a similar pattern in any market or investment you follow, where the mechanics of growth became more important than the actual product delivering value? I read every comment you leave, and I want to know what you see when you look at your own financial landscape after understanding how this one broke.